At this moment, we are still forecasting China's growth rate in 2021 will be around 8%. Yes, there is definitely a downside risk, but I think that China has a policy tool if the slowdown is accelerating further.
Everything we hear and see from our corporate customers and our accounts and those people that are traveling is that we should expect more people in offices and a big inflection point in business demand come January.
What our hope is that Exxon is looking at not just the next year or two, but how they're changing the footprint of how they make money.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Evergrande shares sink on a worsening cash squeeze. A looming dollar bond deadline tomorrow could tip the developer into default. Tesla profit beats estimates, but shares fall in late trading as revenue disappoints. The EV maker warns supply constraints will hurt plans to boost output. Plus, smart conversations on Bloomberg Surveillance Early Edition. This hour, we speak to the DNB chief executive and economist and best-selling author Dambisa Moyo. We also spoke to Unilever chief executive, so I'll bring you all of those shortly. Now, first thing is first, so let's check in on the markets. A bit of pressure when it comes to European stocks. You can see it's not huge, but still a little bit of pressure. For example, the European stocks are down some 0.1%. We had earnings. If you weigh through the earnings, a bit of pressure on margin. If you look at the inflation, so someone like Unilever, disappointed on sales a touch, but they were also able to pass on these increased inflationary pressures onto consumers. Mr. Job told me that actually he hasn't seen inflationary pressures this bad in 2 decades, and he also says that they will last for another 12 months. Look, overall, equities are retreating a touch. Again, inflation, not as bad as it could have been on margins, but still it's ever present, and then a U.S. 10-year at 1.6568. So let's get on to some of the individual countries, maybe, to look at Europe, the difference, for example, with the U.K., where a lot of the conversation is really on what the Bank of England can and will do now. We also have a Bloomberg intelligence piece, which is pretty strong, saying that the worry now is that the Bank of England will have to hike rates and then we'll have to cut them again. The DAX down some 0.1%, a bit more of a loss, so you can see there. This is on the retail stocks, with the CAC 40 down some 0.3%. So, as you were just seeing, European stocks lower on inflation and China concerns. The Unilever chief executive told me earlier that prices have been accelerating to the highest rate in years, or to offset rising raw material costs.
Peak inflation will be in the first half of 2022, and that it will moderate as we move towards the second half of 2022. So I think we're in for at least another 12 months of inflationary pressures.
Well, with us to talk about these trends is Bloomberg's Christine Aquino. Christine, I love speaking to you about some of these markets, so thank you so much. I know you have a busy day for coming on and talking to me about them. First of all, China. So I don't know what to do with Evergrande. I don't know whether we think that Evergrande will actually default, but it's going to be okay because the Chinese government said it will be, or whether we're just going to see much more anxiousness out there on the markets.
Absolutely, Fran. And I think that is the big question, right? Is Evergrande kind of a contained risk, or does it have more potential for contagion, not just in the property sector, but also in general sentiment? I mean, we saw a few weeks ago when Evergrande was really in the news and it seemed to be at the peak of its troubles. That really rattled sentiment beyond China, right? That reverberated across to Europe, because obviously a lot of European companies have quite the exposure to the Chinese property sector, and just generally investors did not like seeing headlines that were negative coming out of China, especially when it involves some of their biggest property companies. And so that is the question once again right now. Seems that sentiment has calmed a little bit over China, but it's not gone away completely, all these worries.
Okay, when Christine says but, you listen, because actually there's always a but. The but is we're also looking at inflation, right? So there's this kind of overarching concern about inflation. But it's a funny old day today. We have, a lot of earnings. There's a couple of stories here and there, but there's not really an overarching theme. So I guess we could see dip buying later.
Absolutely, Francine. I think the story is becoming a little bit more idiosyncratic. Obviously, for stocks, some of the earnings information is coming in, right? And investors are kind of digesting that. Over in bond markets, there's not really a lot at the moment, apart from, still this inflation debate that we're having across markets. Earnings in particular are quite interesting. I was watching with interest the interview with Barclays CEO Jes Staley this morning, and he seemed particularly upbeat, especially especially when it comes to UK consumer spending. You know, he was very notably positive about the fact that it has gone back to pre-pandemic levels. But, you know, we're in the situation where inflation worries, as you say, still plaguing investors. And obviously that tends to hurt consumers quite a bit. And so really one of the questions for me when I was watching that interview was, how long is this going to last, especially when we have the Bank of England potentially tightening before the end of the year?
Christine, what else is on your mind? I don't know whether it's Bitcoin or something else that it's a data point that we should be watching.
Well, Bitcoin, obviously very interesting. I was watching with interest the ETF launch yesterday. And, you know, we saw as well, that's reverberating across the cryptocurrency space. You know, we've seen the market cap in that space reach nearly $3 trillion. That's pretty staggering numbers. And, you know, this is a pretty classic boom-bust cycle that we tend to see with these cryptocurrencies, right? We're clearly in the boom part of this cycle at the moment. Lots of interest, obviously, with the ETF, lots more access that investors are being granted to this market. But with that comes also more two-way risk, right? And so I'd be interested in watching to see how that plays out now that more people have access to this. Is that going to introduce more noise in an already very noisy market?
Yeah, I know Twitter's always alive, saying it's mainstream, you can't afford to stay on the sidelines. Christine, as always, thank you so much. Christine Aquino there from our Markets Live team. Now, we're just also getting some breaking news out of the Norwegian Sovereign Wealth Fund. So let me see if I can actually see those headlines. Norway, of course, one of the biggest sovereign wealth funds in the world. It was an interesting because, of course, it has all of the dynamics of them trying to also to be more ESG friendly. The fund returned some $3.7 billion in the third quarter. Now, that for the moment is the only headline I see, but as soon as they cross the Bloomberg terminal, we'll bring you more headlines from the Norway Sovereign Wealth Fund. We're also joined to talk markets, to talk ESG and many other things by Monica Defend, Global Head of Research at Amundi. Monica, thank you for joining us. The focus today is definitely on earnings. In terms of some of the supply chain concerns and energy price crunches, are companies going to be okay?
Thank you, Francine. Good morning. Actually, the earnings season so far has been surprising me on the upside, because really what we have seen over the summer has been a progressive deterioration of the economic momentum, whilst on the EPS front, so on the corporate fundamental, we have not seen such repricing. So it will be very interesting, and for us, it's a real test on the real economy to see how the reporting season will proceed. I mean, as you said, the slowdown on the economic front and the pressures on margins.
So, Monica, in this kind of environment, what would you be buying? I know there's been a rotation in terms of some of the industry or some of the sectors that you like. Will that just continue, or could inflation upend everything?
Well, I think that what it is wise to do is really to follow this interaction between growth and inflation. And this is really what is driving our investment positioning. So it is not time to take on straight directional overweight into risk asset, rather staying in the relative space, which means, for example, having a preference for those sectors that are more value-oriented, more quality, and somehow defensive. So we can blend energy, healthcare, luxury, favoring those sectors that show some pricing power, like luxury. But it is really a matter of alpha and correct selection of the sectors and of the stocks.
Monica, is there anything at the moment that, is due a big correction? Again, I don't know whether there's a big policy mistake coming. We talk a lot about the UK and the fact that, we could envisage some kind of scenario playing out where the Bank of England has to increase rates and then cut them fairly quickly. Is there anything that you think right at the moment just looks expensive?
Well, everything looks expensive. If you turn to the risk asset, broadly speaking, the top line is extreme in its valuation, and this is a risk per se. When it turns to the Bank of England, but more in general, the central banks are not at all in an easy position, as they have to preserve easy financing condition. So they cannot afford to shrink their balance sheet, but at the same time, they are looking for a way out from their unconventional monetary policy at a time where growth is going down and inflation is going up. And this is the reason why we are neutral when it gets to the equity exposure, global equity exposure, for example, but we still remain tilted into the credit space. So valuation are extreme. This is for us a risk, and this is why we are a little bit cautious at the moment.
Monica, thanks so much. Monica Defend there from Amundi stays with us. We'll talk a lot more about some of her market calls and some inflationary pressures elsewhere. Now, coming up, Evergrande shares sink in their return to trade after the developer's deal to sell a real estate unit collapses. We get the details next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Evergrande troubles continue. That's as talks to sell a stake in its property management arm fell through and real estate sales plunged about 97% during peak home buying season. Now, it adds to the conglomerate's liquidity crisis and, of course, comes a day before the grace period for a dollar bond payment ends. Well, for more on all of this, we're joined by Rebecca Chung-Wilkins, our China credit reporter in Hong Kong. So, Rebecca, thank you for joining us. How problematic is it? Could we actually see Evergrande default?
Well, certainly the kind of falling through of this deal is a real blow to Evergrande, particularly because that unit is really a premium asset. And of course, that bad news kind of keeps on coming when it comes to the sales, the drop in sales for last month. It certainly looks like Evergrande is running out of time. So the grace period is coming to an end for a dollar bond coupon that's already overdue. That's set to be come over the weekend. So investors very, very closely watching. Of course, if we do see a missed payment, and investors and bondholders choose to accelerate there, we could see Evergrande's first ever public bond default. And it really would take us one step closer to this possible restructuring that, of course, might be one of China's largest ever. So it's definitely particularly worrying. It's been another very kind of rocky day for China high yield. We're seeing quite a sharp sell-off in many of the weaker rated property firms. And that's really of this sort of broader concern that there could be a kind of domino effect where we see a wave of defaults coming across the Chinese property sector, particularly because they have essentially been shut out of the offshore funding market, which is this key channel of funding for them. And many firms that have been scrabbling to make these imminent debt repayments have struggled to kind of roll over or find financing for their debt. And we are seeing more and more firms either miss payments or fully default.
Rebecca, thanks so much. Rebecca Chung-Wilkins there, a China credit reporter in Hong Kong. Well, still with us to talk markets and to talk China at the margins, Monica Defend, Global Head of Research at Amundi. Monica, I know you've talked about China and actually looked at Evergrande from the very beginning and the various developers. How has the situation evolved in your market research?
As far as Evergrande is concerned, things are going in the direction we were expecting. This is largely policy-driven. And in general, what is happening to China is driven by the policy agenda. And this is for us what is a matter of concern. The slowdown of China is going to spill over globally. And if I look at our positioning, we were mentioning before, growth will be one of the dominating narrative we will follow. We will see a two-speed 2022 just because of China that is going to miss the 8% GDP target for 2021. That was a kind of psychological threshold that we all had in mind. And this is entirely policy-driven. So what we do fear at this stage is that the policy mix will be a little bit too late in U-turning, in getting less tightened. actually the broad slowdown that we have seen out of China with the latest third quarter GDP numbers shows that the slowdown is going beyond the COVID. So we're talking about energy prices restrictions, we're talking about commodity rise, we're talking about the zero tolerance COVID policy that is having a deep impact on the economic track. And we think that authorities should really turn more accommodative now.
Okay. Monica, I also wanted to ask you about the European Central Bank. So yesterday, of course, the Bundesbank president kind of stepped down unexpectedly, marking the exit of one of the most hawkish members of the European Central Bank. And it's also, comes as it debates its post-crisis stimulus. So there's a couple of successors that we're talking about. Possibly it could be a woman. I don't know whether it actually changes the way that you see, ECB expectations. Yesterday, it didn't really move the market. So I don't know what the market's thinking on this.
Yeah, the idea is that there will be a balancing of power. We will see some continuity out of the broad European policy and the German voice. Actually, I was really surprised by Weidmann leaving, because he has always been there, and he has been really a big man in his statement and in criticizing the ECB, but eventually it was always very aligned when it was a matter to go into the market. So I see some continuity, but definitely this will be a subject that the German government will have to tackle.
So, Monica, where do you find value in Europe right now? I know we're still looking for a capital banking union. Is there anything over the last couple of weeks that you, in your research, actually highlighted as more attractive than just a couple of months ago?
Well, we are still keen on the financials on a selective basis, as well as on the energy side. There are some stocks to look at. Healthcare is another sector we are looking at, and luxury as mirroring pricing power, which is a thematic we think we should follow out of Europe. Still, we think that Europe has not reached the peak yet. So in relative term, if we have to set a preference, we do prefer Europe versus the US, for example. So there is a relative preference there, and then some sectors still towards value and quality that are appealing to us.
Monica, thanks so much. Monica Defender, Global Head of Research at Amundi. Now, more on Tesla. We'll talk about some of the earnings, of course, coming out of Tesla. Also, a little bit, or something that we need to keep an eye on is, of course, their investment in Bitcoin. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So Tesla posted third quarter profits that beat estimates. It reported revenue that fell short of Wall Street expectations. Now, the results mark Tesla's 9th straight quarter of profits, despite some of the obstacles posed this year, such as chip shortages and blackouts in China. Well, to discuss all of this is Christoph Rowold in Frankfurt, who's been covering the auto sector for us. Christoph, thank you for joining us. So were you actually surprised by anything the Tesla results? I mean, it seems that by comparison, they're managing pretty well.
Yeah, I think as you mentioned, the actual numbers were probably a bit of a mixed picture. Slightly weaker revenue than expected, but profitability very strong. Delivery is also something to highlight. But I think what really stood out was the resilience of the company in what are really difficult circumstances. We all report about the chip shortage on a daily basis, rising energy costs, rising commodity costs, and I think given the backdrop of this really difficult market environment, they did really well.
So what are the next steps, Christoph, for the company?
Yeah, the next big steps will certainly be the challenge to basically ramp up production on 3 continents simultaneously. They're preparing for production in Texas, in Austin. At the same time, they're building the factory outside Berlin, here in Europe, while at the same time also increasing output in Shanghai, in China. And to manage all these like three highly complicated and complex projects is definitely going to pose a big challenge.
Christoph, where do you see the biggest risk for Tesla right now?
I think short term, probably the raw material side is something to keep an eye on. I think yesterday the CFO mentioned that they had quite a headwind from aluminum and nickel prices, which are really going through the roof, basically. Longer term, probably the regulatory side of things. Elon Musk had quite an exchange on Twitter about the nomination of the NHTSA's new safety chief, the US regulator, probably taking a closer look on their Autopilot function. And that's definitely going to be something that will not go down well, probably with Elon Musk going forward.
Christoph, thanks so much. Our Bloomberg Frankfurt Bureau Chief, Christoph Ravalt, there talking about Tesla. Now, coming up, we speak to the Chief Executive of DNB Bank, Kirsten Bratten. We discuss earnings, inflation, and interest rate hikes. That's coming up shortly, and this is Bloomberg. Evergrande shares sink on a worsening cash squeeze. A looming dollar bond deadline tomorrow could tip the developer into default. Tesla profit beats estimates, but shares fall in late trading as revenue disappoints. The EV maker warns supply constraints will hurt plans to boost output. Plus, smart conversations on Bloomberg Surveillance Early Edition. Shortly, we speak to the chief executive of DNB Bank, Kirsten Bratten, and economist and best-selling author Dambisa Moyo. You can send your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So first thing is first, we always check on your markets. And the picture overall is one of subdued optimism. So optimism because margins could have been much worse than expected in this earnings season. Caution because there's concerns about China and, of course, some of these inflationary stronghold that could be worse. I'm looking at dollar, pretty much little changed. Of course, it's elevated inflation going forward. That concerns some of the traders' corporate results seem to have tempered but not dissipated worries that cost pressures stoked by this energy crunch and supply chain snarls could slow the pandemic recovery. Now, DNB Bank reported net income that beat the average estimate. The Norwegian bank says its portfolio quality and macroeconomic prospects puts it in a good position for further growth and paying dividends. Well, joining us now is the Chief Executive of DNB, Kirsten Bratten. Ms. Bratten, thank you so much for joining us on today's program. When you look at some of the opportunities for DNB actually going forward, so the bank declared a dividend. I know your results were pretty strong. Where will you see the main activity coming from in the future?
Well, 80% of our activity stems from the Norwegian economy, and there is a very strong and robust situation in the Norwegian macro economy going forward. The society opened up fully again in September. Optimism is on the rise. Vaccinations are at more than 90% in most groups, and we see a rising optimism and desire to invest both across the business sector and spending is expected to be important in the consumer business. So opportunities for our business is growth on the lending side, but also strategically to grow our fee and commissions in savings, investment banking, asset management, and insurance. And these were all strong drivers in this quarterly result, which was our strongest third quarter results ever. So it's a pleasure to report that.
Yeah, and so you've also, gone back to dividends. Do you see the bank buying back shares on top of that?
Our dividend policy stands very firm, and it states that we will pay more than 50% of our results in cash dividend. We target a nominal increase dividend per share per year, and then we use buybacks as a tool to optimize around our targeted capital position. We have at length talked about the resilience in our earnings, and delivering on our dividend policy is something that we are working very hard to do. So with the declared dividend today, we are very, very pleased to say that we have delivered on our dividend policy both for 19 and 20. So the resilience has held up during the pandemic. We will continue to consider share buybacks as a tool. The priority for now has been the cash dividend. We're also awaiting the final decision on an acquisition of a smaller bank in Norway that we have announced. But we're very clearly also stating that we will pay out excess capital to shareholders over time.
If you look at some of your revenues, so trading and customer revenues in your market unit have been pretty strong. Do you see that trend continuing now that people will also be back in the office?
We actually see a lot of optimism on the corporate side, that many investments are being planned in view of the ongoing transition, I would say, to a more sustainable economy. Credit growth in the personal market is expected to hold up at 5 percentage points. We are pleased to see that the customers continue to put their trust in us. We see a healthy growth in personal customers. It's been at 3.7% annualized year to date, and a very strong growth in SME that is annualized of more than 8%. In large corporates, we're very mindful of wanting to turn the capital quickly over. So we have been using the very active capital markets to underwrite but then sell out exposure. This is very accretive to return on capital, which was 15.6% in the corporate banking arm for the third quarter. So GDP is expected at 3.5 in Norway, or 3.8 in Norway this year, and 3.5 next year. So of course this bodes well for a very healthy activity level, and right now the activity level is higher than before the pandemic.
So you also mentioned the acquisition of, I think, Spanken. Or is it likely that we could see actually more acquisitions in 2022, and what kind of size and scope?
I think we're very clearly saying that organic growth is sort of our main engine. Growing organically and paying excess capital to shareholders is the main engine of our business. Strategically growing capital light income as commission and fees that we've said over time should grow at a pace of 5% per year, slightly higher than lending, where we're saying 3 to 4. We've also all the time said that we will opportunistically, selectively look at bolt-on acquisitions. Spanken being the largest we've looked at in a while, but still relatively small. We've also done a smaller acquisition in defined contribution pension and a couple of other areas. So I think this is a part of the normal ongoing business. But organic growth is where we put our main focus.
Can you talk us through a little bit of the climate change ahead of COP26? So how's your progress in actually helping oil companies transition to a carbon emission cutting world?
I think in our view, this is going in the right direction. And there's been a tremendous shift if we compare the situation today compared to prior to the pandemic. I like to say that we've gone from a push to a pull. I mean, we've talked about our customers with this for years, but the sensation in the past, I'd say, 9 to 12 months is that customers have turned around and are really pushy on us, wanting to have advice and discussions and a dialogue on how they best can transition their business and what they need to do in order to be able to access capital ahead in time. So there's a lot of investor appetite for sustainable investments. There's a lot of innovation in the companies, I'd say. We are not going to solve this by 1 or 2 single innovations. I think here we need a variety of innovation and a variety of partnerships and cooperations across value chains in various industries. And in this sense, we're very optimistic, I'd say, and positive about what we see in Norway. Being a small country and being a country that has strong traditions to cooperate is something we see yielding fruits in a lot of companies finding together, initiating innovations in areas such as renewable, floating wind, offshore wind, hydrogen, and battery production, to mention a few.
Kirsten Brattem, thank you so much for joining us today, DNB's Chief Executive Officer there. Now, coming up, global economist Ambisa Moyo joins us for an exclusive conversation. We'll also talk to her about ESG investing. She was an MC at that Global Investment Forum by Boris Johnson. That was just 2 days ago, so it'll be really interesting to get her views on what comes next for the UK. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, a clean energy revolution is sweeping through the markets. From EV makers to solar companies, stocks in the sector have delivered billions of dollars of trading profits to investors across the globe. Now, it's all part of an overall shift of focus to ESG investing. Earlier this year, Norway's sovereign wealth fund cautioned that the inclusion, though, of climate targets in its strategy could put returns at risk. Well, we're now joined by global economist, author, board member at 3M, Chevron and Condé Nast, Dambisa Moyo. She's also fresh from acting as MC for the Global Investment Summit held by the Prime Minister Boris Johnson. So, Dambisa, always a great pleasure to speak to you about the world economy and also sustainability. And thank you so much for joining us after such a busy week for you. When you look at the government pitch that we saw a couple of days ago, especially, the UK government, but the Prime Minister himself, to global business and global Wall Street. Did it work? What's the message of the UK when it comes to sustainability and investing?
So thank you so much for hosting. I'm delighted to be here. The message, I think, was very clear, that there is a commitment in all sectors, government, private, as well as civil society, towards a low carbon future, one in which we can all sort of get behind. I think too often the conversation's been about risk mitigation. So things like emissions, things like scope 1, 2, and 3, which are all clearly important. But this was really a big push, telegraphed as an investment summit, looking at opportunities into the upside from solar, wind, geothermal, biofuels, nuclear Gen 4, et cetera, et cetera. So very clear message. We need money to flow into these areas. As you know, it's not just about the D in R&D, it's also about R. We need to fund innovation. It's critically important that large sums of money go into these research areas in order to meet the targets and hopes to achieve net zero targets by 2050.
Dambisa, are we going to see actually the UK? I mean, the UK, and especially the City of London, is now trying to be the green capital of the world. What needs to happen for that to become a reality?
Well, I think that one of the key areas that was discussed, and I think is really important, is this notion of a green premium, that actually there is a delta between the cost of energy today, relying on the current energy stack, which is highly skewed towards fossil fuels and existing sources of energy, into moving into more green-based energies, which unfortunately are still very expensive. And really, as part of what the goal for the city, as well as broader investors, is to show that the UK is at the tip of the spear of trying to help, and by that I mean the UK government, trying to help close that gap by funding or at least providing a baseline for interventions and innovation in the R in particular, but both in R&D. In offshore wind and solar, they've already made considerable investments, and they really are trying to drive and attract additional investments into the space.
Dambisa, I know you also sit on a number of boards. You wrote a wonderful book explaining exactly how boards work. What's the relationship right now amongst a lot of the board members and the head of ESG and sustainability? Do we actually need a chief executive that does sustainability instead of a lot of times dishing it out to a unit?
Yeah, so, I think just if you think back to the way that the evolution of ESG, certainly post 2019 and the whole effort around the Business Roundtable statement, we've moved from sort of ESG being a sort of ancillary secondary piece into very much integrated into how businesses are operating. I was delighted to see Jamie Dimon, as well as Steve Schwartzman and Larry Fink in the audience at the Global Investment Summit, because they really do influence a lot of what institutional investors want to see, but also they understand that sort of split between people who focus on sustainability versus portfolio managers that gap needs to be closed. And so I think that the conversation, the lexicon of business has become much more focused on continuing to generate returns, but understanding it's not just financial returns, it's also about returns to society. And we talked a lot about in the presentations and discussions that we had at the summit. So I'm pretty optimistic that we won't have this schism between sustainability on one side and sort of financial returns on the other. We need to clear the cost of capital, of course, but I think that the conversation is becoming much more integrated and therefore much more sensible.
And so are they going fast enough? Some of the discussions that you're having at board levels, either on the boards where you sit on or also, others, because I know you speak to a lot of people, is there a feeling that actually the sense of urgency is now, or are they still being distracted by the COVID and actually dealing with the fallout from the pandemic?
I think that's a great question. That we have to understand where we are. We are now in a situation where we know that we're consuming 100 million barrels of oil every single day in the world economy. We know that we have 50 billion tons of emissions. And even with coming out of COVID and emissions were still rising, even though we've been sitting at home for the last 18 months. We also know that we're looking for $5 trillion of capital, according to the IEA, to meet the targets by 2050. So we have a very steep climb. There's no doubt about it, whether it's in public policy boardrooms, corporate boardrooms, or even endowments. I serve on the Oxford University Endowment Investment Committee. The conversation is very committed to coming up with solutions that actually generate upside returns without losing people. We have 1.5 billion people around the world who've got no access to energy. We can't lose those people in sort of haphazard and unthoughtful approaches to dealing with this very serious crisis of climate and the need for action.
But we are losing people, aren't we, Dambisa? Even if you look at vaccine distribution, I know you've spoken about this extensively. It seems that the gap between the have and the have-nots is getting much starker in a society, in a country, but also between countries.
Yes, absolutely. And that's what we need to remember. We don't want to end up so vigilant to deal with one crisis that we lose sight of the broader construct. And one of the things that I emphasized in my MC role at the summit is that there shouldn't really be an either or. It's very hard to prioritize, of course. Do you pick COVID over climate, or do you think about growth and long-term structural challenges or digitization, inequality? I mean, the list is pretty long, but I think if we start to think about this as a more holistic approach and bring more people around the table from different backgrounds instead of having sort of disparate conversations, COP26 focusing on policy, but over here, investment summit, where people are talking about investment, we really ought to all be in the same room thinking about these issues because they are multi-generational, they're multi-dimensional, and therefore very complex. So I am sanguine that those things are starting to happen more and more. There is a clear recognition that this is urgent, it's enormous, and we should not be leaving people behind. And I think that that's where the sensible conversation opportunity comes from.
Debbie, I know you spend a lot of time looking at inequality and these crossroads. If the bad effects of what we're living through gets unevenly distributed, how much time do you spend thinking about inflation?
A lot, a lot, because obviously that could undermine a lot of efforts put in place. Obviously there's an ongoing debate. Is it temporary? Is this more structural? I mean, I tend to lean more sanguine with the view that, and a lot of the stuff is things that I see in the boardroom. Certainly there are inflationary worries. You saw the 5.4 print in the US recently, but I am pretty sanguine that sort of at the very latest by Q2, we should see a lot of the container concerns, port blockages relieved, and potentially even before that, if we can actually have better, more cooperative conversations going on, not just between US and China, but also across Europe and elsewhere. So clearly supply chain problems. We know about the work from home challenges as people are coming back to the office, and COVID's not gone. We continue to manage through that. But I am fundamentally optimistic that technology will continue to keep prices relatively down.
But Dambisa, this is what in the shorter term, actually, the prices go back to a more normal level. And if the energy crisis keeps on going, what does it mean for, again, the people that have the least?
So I just wrote an article, was published yesterday in the Financial Times, looking at that risk, the risk of too much money essentially going into the ESG space and what those risks are. And you're right that, if it's done in an undisciplined way without due consideration to business principles, there is a real risk that we end up with inflation, that the traditional energy companies start to reduce their investment in the energy stack today, and we end up with a lot of money, a wall of money, chasing ESG assets or renewables assets. And we're seeing that already in market pricing. The multiples, even before Series A, so early investment rounds for renewables, is incredibly high. That is a real issue that if it's mismanaged, could could transfer energy costs and make it much more expensive for households. And that is something that I really know from discussions with the policymakers, they're very focused on that and trying to make sure that we manage this transition in a very careful way. And I think that's the real point I want to leave with people, that the transition is going to take a long time. It's much more complicated to move from one equilibrium to another. We don't want to lose people, as I said earlier, but there are these second order costs and considerations we need to think about.
What do you think will be, the pandemic legacy away from some of these supply chain concerns? Is everyone going to have more flexible working hours, or is it return to the office back like 2019?
I think it varies really by, different organizations. I think that, I can see how creatives might want to be in one room, but people who are in sales potentially could be at home and do it that way. But, I personally have enjoyed being in rooms where I can debate and have conversations and look in the whites of people's eyes. But, I totally understand that this is not something where you can just sort of legislate from on high. I think it'd be very much tailored to the unique businesses and how organizations operate. But, from a specific individual career perspective, I have certainly benefited from being in the office, but I understand the considerations that go into that decision.
Dambisa, thank you so much. As always, Dambisa Moyo there, a global economist and author, joining us this morning. Now, coming up, we'll have plenty more on the markets. We look at earnings, a bit of inflationary pressures, but actually could have been much worse on margins. Some markets kind of tailing off on that. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Barclays bankers made the most of the booming deals market, helping offset more muted earnings at its trading units in the third quarter. Investment banking fees rose by 59% to £971 million, following the strong performance of US peers. Analysts had predicted £775 million in revenue from this business. However, revenue from fixed income trading plunged by 20% as a rally that drove record profit a year ago faded. Now, Tesla's revenue trailed estimates, but profit beat despite a chip shortage, rolling blackouts and supply chain issues. The electric vehicle maker delivered a record 241,000 cars globally in that period, marking its ninth straight quarter of profit. It also reported a Bitcoin-related impairment of $51 million. And PayPal is said to be exploring an acquisition of Pinterest in a deal that would value the social media company at about $45 billion. Sources say PayPal recently approached Pinterest about a potential buyout worth around $70 a share, an 11% premium over Wednesday's closing price. And that's your Bloomberg Business Flash. Francine.
Oh, Leanne, I'm so torn. I'd love everything. I mean, if you have like a super app, a little bit like WeChat or Pay or, Alipay in China, you don't need the 300 passwords that certainly I forget. I know you have a better memory than me, but then you give all the data away to everyone as well.
Francine, I just have to say one thing. Pinterest, my latest obsession. I bought a new house and my whole house looks like Pinterest.
Oh, check it out, Pinterest. Bloomberg Surveillance Early Edition continues.
Is inflation transitory? And our house view is that it is going to moderate from the extraordinary price increases that we've seen over the summer, but that the likelihood of it being higher than it was pre-pandemic is going up.
I think we've just come to the realization that inflation is going to persist for longer. Inflation expectations are likely to rise more than expected.
Peak inflation will be in the first half of 2022. And it will moderate as we move towards the second half of 2022.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, October the 21st. Our top stories today. Tesla sales fall short, but profits beat. The EV maker showing progress despite a chip shortage, rolling blackouts, and supply chain issues. Evergrande shares sink on a worsening cash squeeze. A looming dollar bond deadline could tip the developer into default as soon as tomorrow. Plus, inside Norway's $1.4 trillion sovereign wealth fund. That is the world's biggest, and we will speak exclusively with the fund's deputy CEO in moments. Good morning, everybody from London. Kailey, we heard a lot in the opening sequence there about inflation and inflation concerns. Is it that roiling markets, or is it fears around a slowdown in China? They're both in the mix today.
Well, take your pick, Anna. There is a wall of worry that the equity market has, by and large, continued to climb, but it does look like that will not necessarily be the case today. In Asia, it was a mostly red session overnight. Looking at GMM Go on the Bloomberg terminal, you do see a lot of red. Broadly, a down day for bonds, down day for most currencies as well, though the Japanese yen is a big outperformer, the strongest currency in Asia, and that weighed on the Nikkei, which was down nearly 2 percentage points. You also had Hong Kong stocks lower as well, but one of the outperformers within the Hong Kong session was actually the property sector. The Hang Seng Property Index up more than 2% after the regulators in Beijing said that risk can be controlled. Of course, that risk largely stems from China Evergrande, the heavily indebted property developer, and its shares resumed trading today after being halted since October 4th, pending a major transaction. That transaction, which was supposed to be selling a stake in its property services division to Hobson, is no longer happening. So the shares opened once again and down 12.5% in the overnight session. Of course, where a lot of the inflation fears that Anna was talking about come from the fact that we are seeing really elevated commodity prices. And that is true of coal in China. Beijing is really trying to rein that in, and they are having some success because coal futures fell 11% overnight. And then, of course, speaking of inflation fears, I would point to the 10-year Japanese break-even, which shows inflation expectations over the next 10 years. That rose to near above 41 basis points, which is the highest going back to November of 2018. Now, here in the U.S., stocks have been climbing that wall of worry thanks to largely better than expected earnings. The S&P 500 up 6 days in a row, its longest winning streak since July, and within a point of an all-time high. But this morning, futures are in negative territory. We're down about 0.25% on S&P E-minis. In the bond market, we also are seeing yields moving lower for the first day in 5. The 10-year Treasury yield sitting right at 164. Oil moving lower as well. We're below $83 a barrel on WTI. And Bitcoin, another record high, Matt. Of course, we got a taste of 66,000 yesterday. And once again, we are above that level. Thank you very much to the hype around that futures ETF.
Yeah, the hype around futures, and anytime China or Jamie Dimon badmouths it, apparently, that's a great contrarian indicator. Take a look at what's going on with stocks here. We're down across the board in Europe. They're not huge drops, but they're being weighed on. Again, as Anna said, by concerns about inflation at some companies. Others have done well at passing on inflation costs. And we got a slew of earnings this morning. So let's go ahead and go through some of the stocks that are moving. Barclays first and foremost, although it's the smallest. I put together a board of stocks for you here, and I've organized them in order of market cap, smallest to largest. So Barclays is about a $46 billion bank. They did great with M&A advising and charged incredible fees there. So the street likes their earnings report, but investors maybe had a little bit of buy the rumor, sell the news here. ABB is one of those companies that's facing real supply constraints. This is the chips and ships problem. ABB, of course, is a massive industrial company. It also trades on the New York Stock Exchange, and they have said they're concerned that the supply constraints are going to last beyond the fourth quarter. They cut their revenue outlook. Unilever is the company I was talking about that's doing well at passing those costs along. Unilever makes delicious Hellmann's mayonnaise, as well as Breyer's ice cream and Dove soap, and a million other things. It's like the P&G of Europe. They've managed to pass costs along, but their CEO told us earlier that he thinks inflation is going to last at least another 12 months. And then finally, I've got SAP here. They've done really well selling their cloud products, the S/4HANA cloud products. No one actually knows exactly what that is, but it's somewhere up there, Anna.
somewhere in the cloud. Okay, Matt, with the detail then on those European corporates, yeah, Unilever, a real standout to the upside on what is a down day. Let's have a look at what is ahead for us today. Get a quick look at the agenda. Turkey's central bank is expected to cut rates at 7 a.m. New York time. This is after the country's president fired 3 policymakers, of course, who may have opposed such a move. We'll focus in on Turkey then. EU leaders are also gathering in Brussels for a 2-day summit to discuss COVID, the rising case numbers in Europe, also energy prices, migration and trade policy, and a potential standoff with Poland. We'll have a conversation on that later. And WeWork is in the final stages of a plan to go public with SPAC BowX acquisition. The combination, or the combined company, will begin trading on the New York Stock Exchange today. It seems we've been talking for years about just exactly how WeWork comes to market. Now to another hot topic. Tesla reported third quarter revenue that fell short of Wall Street estimates, but managed to beat profit projections. The results mark the 9th straight quarter of profit for the 18-year-old electric car maker. In the earnings call, the CFO says the company has felt cost headwinds on nickel and aluminum.
We have a mixture of contracts with various suppliers. Some materials we contract directly and we have full exposure to price fluctuations. We do have a number of long-term commitments, long-term contracts in place. As these have been moving, some of those costs have been flowing through to us. It's not a substantial amount of cost, but it's not small.
Let's get to Bloomberg's Tom McKenzie, who has analysis of this for us. Tom, good morning to you. So managing to beat the chip shortage to some extent, what were the takeaways?
Pretty remarkable that they managed to deliver 241,300 cars in the third quarter despite those constraints. And they did highlight that. Zachary, the CFO there, pointing out that these supply chain constraints were an impact. They continue to be an impact. The revenue rose 57%, as you said, below the estimates. So they came in at 13.8 billion. The estimates were 13.9 million. But it was the profits that really stood out in terms of the improvement there. So profits, earnings per share, beating the estimates, margins at a record level of 30%. There isn't a problem with demand when it comes from Tesla. It's about getting the cars to their customers, and that problem persists.
Yeah, absolutely. I would ask what's next. I know a number of people who have orders in for the Cybertruck. That's been pushed back. I'm still waiting to see the new version of the Roadster. They've got the Semi coming out. I've seen pictures of a 4-wheel drive vehicle that's rumored to be in line for production. What's coming up for Elon Musk?
Yeah, and the timing of all of those launches will be down to how they secure these supply chains, as you know, Matt. So in terms of the Cybertruck, they're still looking at 2022 for that. Also the factory build-out as well, which could help in terms of meeting this strong demand for Tesla and its products. So you've got the build-out in Austin, Texas. You've got the build-out in Berlin, Matt, as you know about. And also, let's not forget about China. You've got Wedbush Securities coming out saying China's going to make up more than 40% of overall deliveries by 2022. That Shanghai factory still supporting, and that demand from China still supporting what you're seeing in terms of sales for Tesla.
Yeah, and Tom, we'll be speaking to that Wedbush analyst Dan Ives later this hour, so stay tuned for that. Thank you so much to Bloomberg's Tom McKenzie. Meanwhile, let's turn to Evergrande because its crisis is deepening on the eve of a dollar bond deadline. Shares of the property giant plunged after talks to offload a stake in its property management arm fell through. Sofia Orta-Acosta, Bloomberg's chief China markets correspondent, joins us now from Hong Kong. So, Sofia, it also said that it has made no further progress on asset sales and may not be able to meet its financial obligations. If it's not through this particular asset sale, where's it going to get liquidity from?
That is the key question. This was, of course, the property management unit that is Evergrande's crown jewel. And it was bound to be a sale that would raise more than $2 billion for the company. Now, if Evergrande can't source that money, it really needs to do that pretty quickly. It needs to find more than $80 million to pay just a coupon on Saturday, and that's after a 30-day grace period. Evergrande's already delayed on that payment, and the concern here is that failure to pay that coupon on Saturday could eventually constitute a default. Obviously, because that falls on a weekend, we might not get details until Monday, but that would be the big one. An Evergrande default could come as soon as Saturday.
So the story around Evergrande is dramatic enough, Sophia, but if you think about the property sector in China as a whole, I saw one of our colleagues today referring to this as having the potential to deliver the fastest or most drastic slowdown in the Chinese economy in a generation. What do you anticipate for the housing sector as a whole here?
Yes, exactly. And we had a number calling it predicting a bear market in China's property prices. Now, we saw data recently showing home prices dropped 17% in September. This is very much engineered by Beijing. It's a deliberate policy to remove speculation and decrease leverage in the property market, where household assets are 40% invested in this property market. But when you say, we've heard the PBOC, we heard the Vice Premier, we heard the banking regulator all saying that risks are very much contained. But 3 developers have already defaulted in October. We could get another one in Evergrande. Kaiser has a coupon payments due tomorrow, and another developer on Monday is struggling to repay another bond, $250 million worth maturing on Monday. And Anna, it could get a lot worse in January, where obligations are actually more than twice as much as they are in October. So it's not, we haven't seen the worst yet.
We will be paying close attention. Sophia, thanks very much for joining us. Sophia Horti Costa there talking to us about Evergrande. Now to Washington, D.C. Democrats are split over President Biden's economic agenda. Negotiators are reworking tax hike and climate plans to help win the support of Senators Kyrsten Sinema and Joe Manchin. Jack Fitzpatrick, Bloomberg government reporter, joins us out of D.C. to help us understand what we're going to actually get at the end of the day. Jack, what do we know?
Lawmakers even don't know very much right now. One of the big issues they're facing in the last couple of days is that Senator Kyrsten Sinema is said to be opposed to increases in the corporate tax rate and the top income tax rate, which are two of the cornerstones of what Democrats planned to do to raise revenue for everything else they wanted to do in terms of spending. It's also clear that some of these spending ideas are going to have to come down. Lawmakers have discussed leaving out entirely the free community college provision of this reconciliation bill. And of course, there's ongoing skepticism that Senator Joe Manchin will sign on to many pieces of the climate agenda in this bill. There's still outstanding questions of how hard everybody's red lines are on this, and especially if Senator Sinema will hold to that idea of stopping increases in the corporate tax rate and top income tax rate. So there's a bit of confusion in Washington right now, but overall the view seems to be of a massive scaling down of Democrats' ambitions at this point.
And it seems every time there's a step forward, there's 2 steps back in terms of progress. Where we are getting some more progress maybe is on the vaccine booster front, after the FDA cleared Moderna and J&J boosters and also said you can mix and match the different vaccines. Where do we stand, Jack, in terms of vaccine politics and how divisive it has been within the U.S. populace?
Yeah, that recent news on booster shots and mixing and matching probably is good news for millions of Americans, but it doesn't really get to the core issues that we've seen the president talk about in terms of vaccine hesitancy. It doesn't necessarily simplify things for how you get your kids vaccinated either. Probably bigger news eventually would be an expansion of availability to kids under 12 years old, and obviously anything that could get people who were hesitant in the first place to get vaccinated really get at the main political questions here in the U.S. But obviously it's not small news to approve the Moderna booster, the Johnson & Johnson booster, Moderna, of course, being for people 65 and older, Johnson & Johnson for 18 and older. So that can be significant news for people who already were probably vaccinated or looking to be vaccinated.
Right, but boosters just one part of the conversation. There's still millions of people that need to get their first shots. Thank you so much to Jack Fitzpatrick of Bloomberg Government. And let's get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. One big mover to the upside is Tri-State Capital, and this is on news overnight that Raymond James is going to buy the company for $1.1 billion worth of cash and stock. As a result, that stock is up more than 24% in early hours. To the downside, though, is Globe Life, which is a life insurer. It missed expectations in its report after the bell yesterday. It also cut its full year outlook. As a result, that stock is down about 2.5%. And then, of course, a big Bloomberg scoop from yesterday was around Pinterest and the possibility that PayPal is looking to buy the company for $45 billion. The shares rose 13% on that news yesterday. Maybe just a touch of profit taking, though, this morning, because now they're down about 0.6% before the bell, Anna.
Kailey, thank you. Coming up on the programme, we'll speak exclusively with the Deputy CEO of Norway's sovereign wealth fund, which holds the world's biggest stock portfolio, exposure to equities, to fixed income, to real estate, and increasingly also to transition energy products. We'll talk about that. And Wedbush analyst Dan Ives gives his take on Tesla's third quarter results as the EV maker beats on profit and disappoints on revenue. What impressed him? Plus, the view from Barclays. We'll hear from our interview with the CEO of Barclays, Jez Staley, as the European bank earnings season really ramps up. This is Bloomberg.
Peak inflation will be in the first half of 2022, and that it will moderate as we move towards the second half of 2022. So I think we're in for at least another 12 months of inflationary pressures. We are in a once in 2 decades inflationary environment, and therefore we have stepped up the level of pricing.
Unilever CEO Alan Jope on the inflation outlook. Of course, Unilever, the maker of so many branded goods that find places in our homes. So really interesting to get his take. Let's take the micro to the macro. Greg Ritchie, Bloomberg Markets reporter, joins us here on set in London. Very good to see you this morning, Greg. So we heard there Alan Jope talking about his inflation outlook and the fact that he says his company has pricing power. How do we tie in? He sees a 12-month inflation pressure ahead. How do we tie that in with what the markets are expecting at the moment?
I think that's pretty much in line with what markets are expecting. We're thinking we're going to see a peak sometime in the first half of next year. The uncertainty is what happens after that. So if we look at long-term gauges of investor expectations for inflation, 10-year break-evens, for example, they're at multi-year highs, whether we look at the UK, whether we look at the US. So in the UK, we're at the highest since about 2008. In the US, since about 2013. The issue is, this is really concerning because it's happening at the same time as we're pricing in a far tighter central bank policy path, both from the Fed, Bank of England, ECB. It's kind of raising the question that markets are questioning the central bank's inflation credibility.
OK, so inflation expectations on the rise at the same time as we expect central banks to do something about it then, Matt?
Well, I'm just wondering, in terms of the earnings reports, we're all watching for inflation to be pushed through. We're seeing some of that at Unilever, for example, but we're also seeing outlooks cut. ABB, for example, says fourth quarter sales growth is now going to look just like third quarter sales growth because of supply constraints. Is the supply issue maybe more of a concern than the inflation issue?
Definitely. I think that's definitely the case. And if you speak to central bankers, all they'll talk about is how they've got a very limited reaction function when it comes to supply issues that you highlight. The issue is, though, they've still got to do something about this because they don't want these inflation expectations to become entrenched. They've got to try to get these long-term inflation expectations down. The risk for them is that these supply issues drive up wages, which drive up further inflation expectations among consumers, and it becomes something that they can't control anymore. So they've got to act even if their policy tools aren't perfect at dealing with supply-side issues.
OK, Greg, thanks very much. Thanks for joining us. Bloomberg's Greg Ritchie. More on the markets next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. Now let's get the first word news. And the Fed's Randy Quarles has added his voice to the chorus calling for tapering to start in November. Quarles spoke at the Milken Global Conference, denying that the Fed is behind the curve in responding to rising inflation, which he still believes is transitory. Elsewhere, Cleveland Fed President Loretta Mester told CNBC that the central bank will not be raising interest rates anytime soon. The UK and New Zealand have agreed to a trade deal which includes improved business travel arrangements and reduced tariffs on clothing, buses, ships, and bulldozers. It's a symbolic and political boost for UK Prime Minister Boris Johnson, but government analysis last year estimated such a deal would have no long-term impact on the British economy. China reported 20 local COVID infections on Thursday following a flare-up in some northwestern provinces. At least 8 provinces have reported infections in the past week, with cases spreading across the country to areas including Beijing. That's fueling concerns that China could see yet another widespread outbreak. And Bitcoin rallied to a record, topping $66,000 for the first time as optimism surges for greater mainstream acceptance. That follows the successful launch of the first exchange-traded fund for investors. The cryptocurrency added more than $1,000 in a single minute just after the open in the U.S. on Wednesday. Coming up, we know that Tesla holds Bitcoin all in his balance sheet, and we will talk about its results that we got after the bell yesterday with Dan Ives, Wedbush Securities Senior Equity Research Analyst. That conversation's coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London with Matt Miller in Berlin, Kailey Leinz in New York. And Matt, when we look at the European equity markets, a little bit underwhelming the performance today, but Unilever a real standout, lifting that sector, fast-moving consumer goods, household products to the upside, and it's all about pricing power. That seems to be one of the key things. If you can demonstrate pricing power, your stock can outperform.
Yeah, absolutely. I mean, and Unilever has so many products that compare well with Procter & Gamble, which didn't really perform that well. Yesterday, Procter & Gamble and a lot of its peers were pounded down to 20-year lows. So it's interesting to see Unilever doing this well in the face of the inflationary pressures. And I guess the key is just passing those on to consumers who are going to be willing to pay.
Mm-hmm. Yeah, absolutely. And on the inflation narrative, perhaps getting a little break from that today with oil prices a little weaker, mining stocks weak here in Europe. What are you seeing ahead of the U.S. Trade then, Kailey?
Yeah, that's exactly right, Anna. You're seeing a cooling really across the metals complex in particular, and that is showing up in the European session where stocks are lower broadly. The stock 600 down about 0.2%. But as you said, Anna, it is basic resources that is the massive underperformer. That sector is down about 3%. Now, here in the U.S., we are coming off of a 6-day winning streak for the S&P 500. This morning, though, when it comes to the future session, we're a bit softer. S&P E-minis down about 0.25%. You are seeing yields coming in as well. The better part of 2 basis points on the 10-year Treasury yield. We're just south of 164. And then, as I said, you are seeing a cooling across the metals today, and that is true for copper with futures down about 2%. In the pre-market session, that is showing up as well with metals and materials stocks, some of your underperformers, the likes of Freeport-McMoRan, Cleveland-Cliffs, and U.S. Steel, all down in the realm of 1.5% to 2.5%. And then I just had to note Tesla as well, because, of course, that was the big earnings story U.S. side overnight. It did have light revenue, but profit topped expectations, margin expansion, a really big story. And at the end of the day, Matt, the issue really is the fact that demand is really strong. It is the supply challenge trying to keep up with that.
All right, so we'll continue to pay attention to those. Very interesting, especially, I think, Tesla, considering it's done so well on profitability, but has issues with revenues, which is the same across all car makers. But Tesla maybe is going to be a little bit more under scrutiny because of the developments it still has to achieve. Let's get over to Norway right now, and specifically the Sovereign Wealth Fund. It is the world's largest. It's actually the biggest stockholder in the world. They own 1.5% of all global equities, which I think is really fascinating. They had a 0.1% return in the quarter, which seems tiny, but it's better than their benchmark, and it's about $3.7 billion. That on top of the money they made with just currency appreciation is pretty astounding. The fund was created back in the 90s to invest Norway's oil and gas revenue abroad and has now delved into renewable infrastructure for the first time earlier this year. We welcome, for an exclusive interview, Trond Grande. He's the Deputy CEO of the Sovereign Wealth Fund. Trond, thanks very much for joining us. Let me ask first about your performance. It seems like a small number, but with such when you're working with such large figures, and as I mentioned, it actually beat the benchmark, it's an achievement. How did you get here? What was your strategy?
Okay, yeah, thanks for having us. So as you say, I think the third quarter for us was a tale of two halves. I think we, through the summer, saw a continuation of the good equity markets we saw in the first half. And you saw the interest rates falling as well. And then something happened in late August into September, where equity markets came down again and the interest rates started to rise. So overall, as you said, for the quarter as a whole, we ended essentially flat, which is an okay result for us. We did manage, as you say, also to outperform the benchmark by 25 basis points, which is a very good result, actually, with the kind of relative risk that we're running. So we're happy with that. But we were broadly invested in the equity markets and the bond markets, and we follow them closely.
Yes, you're broadly invested in equities, good morning to you, Trond, and in fixed income and in real estate and now in renewable infrastructure. Do you go looking for new asset classes at this point? With inflation becoming such a story, Trond, and returns available on fixed income markets maybe not delivering what you want versus inflation, where do you go in an inflation environment like this?
Yeah, it's a good question. Not many places to hide, really. So we're kind of we're a very long-term fund, right? So the bulk of the portfolio is made up of 70% global equities, and by that token, we're owning 1.5% of all listed equities, essentially, in the world. And then we're adding a few asset classes. You mentioned real estate, which was added 10 years ago, and quite recently we added unlisted infrastructure for renewable energy as well. So those are new asset classes for us, which brings diversification and stability, and hopefully also some more inflation protection going forward.
Do you get a bit more experimental, Trond? I mean, we spend a lot of time talking about Bitcoin at new record levels. This might sound a little bit out there for a sovereign wealth fund, but we're hearing a lot of investors talking about how this is increasingly accepted, maybe just as a speculative asset or for some as part of their investment strategy. Do you have any conversations at all around crypto, Trond?
No, I think being experimental is not part of our DNA, actually. We're a very large long-term fund, so everything we do is very deliberate. We're not jumping on the latest craze or bandwagon. And so Bitcoin is absolutely not something that we're explicitly looking into. I mean, we're looking into the large asset classes that are out there because we have so much capital to deploy. We just need liquidity and stability.
Okay, so you're not necessarily interested in crypto, but let's talk more about your push into renewables and renewable infrastructure. Given that Norway also is attempting to get to net zero in the coming next few decades, how will that impact your management of the fund?
Well, it's kind of two parts to that, right? We're managing the fund as a surplus fund. So the first part is really a question of the balancing of the budget in the Norwegian government, and there the oil revenues still play a significant part. I think everybody in Norway is cognizant that this is a cash flow that is going to be falling in the years to come. So there's one debate being had, which is what is new oil, so as we call it here in Norway. What is the new industries that we're going to build here? The other part is and that's for the fund. Climate risk in general is a big risk also for a financial investor and a long-term investor like the fund. So we're actually working quite a lot with the companies, trying to influence them to be better at their disclosure, better at the target setting, and so forth. And then, as you mentioned, we have added the infrastructure on renewable energy, which is not to invest in a specifically green manner, but it's diversification, and we see that this is a growing asset class.
Well, obviously, climate is the E in ESG, and then there's also the SG, the social and governance aspect. How are you thinking about that, Trond?
Well, it's an integral part to what we do. We want to be a long-term responsible investor. And so this is actually something that's been front and center in everything we've done for the last 20 years, I would say. It's nothing new to us. And what we really do is to work on three pillars. We're working with different standards setters, regulators. Since we're kind of invested in the whole world, we think it's a good thing that if the bar is raised for everyone, it's probably a good thing for everyone, the world, and us as an investor in them. The second part we do is to make sure that we are an active owner of the companies. We own 1.5% and sometimes more of the largest companies in the world. So we have a very active dialogue, and we make sure that our voting is consistent with being a responsible investor. And the last thing, and not least, we do is also to slightly tilt the portfolio out of industries or sectors that we think are not on a sustainable path, and then tilt the portfolio slightly into more sustainable business models.
Trond, thanks so much for joining us. Pleasure to spend some time with you today. Trond Grande there, Deputy CEO of Norway's Sovereign Wealth Fund. Now, not only an owner, but Norway's Sovereign Wealth Fund is a buyer of Tesla shares as well, or at least has boosted its holdings over the last year. Let's turn to Tesla because they came out with earnings yesterday. The EV maker showing progress despite a chip shortage in terms of its profitability. Rolling blackouts, it's facing those problems with higher energy costs. The supply chain issues that everyone's facing as well are a big problem in terms of the revenue side of the business. Let's get more on Tesla's earnings with Dan Ives. He's an analyst at Wedbush Securities. So Dan, talk to us first about what do you make of the earnings report yesterday, and how much of a problem are the supply constraints?
Yeah, look, this was a massive quarter, especially in light of the chip shortage. If you look what the company's doing right now, demand's outstripping supply by about 30,000 units. And I think that's important because this green tidal wave for Tesla is sort of hitting its next gear. But look at the margins, despite the chip shortage, beaten by almost 300 bips. I mean, this is a company that has almost a 13 billion EBITDA run rate right now. And I think this just, to us, is sort of just the early innings of the margin story taking hold with Tesla, which was always sort of the Goldilocks as we got into the other side of this, despite the biggest chip shortage in the last 20 years.
You know, we were talking during the commercial break about UK basketball freshman Tyrone Washington. He's going to be, I think, one of the first of a crop of college athletes that gets sponsorships, and maybe because his name is Ty, he chose a Porsche dealership to sponsor him. He'll get the Taycan, obviously. Is that a problem for Tesla? Its competitors are coming out with some really impressive electric vehicles.
No doubt. I mean, if you look at Porsche, and you'll see many others, 100 car makers right now going after EV, part of this green tidal wave. But it comes down to that moat, the battery technology, the supply now with Berlin and Austin coming on board. I mean, they're leading by, really years in terms of battery technology. And that's the key. That's ultimately for Tesla. That really is that sort of moat they built. And you're seeing that play out. Think about chip shortage, all the headlines that we're seeing, but yet this company beat deliveries, and it looks like we'll be clearing close to about 900,000 units this year. Yeah. And I think it just shows what Musk and company have built.
Well, Dan, on the subject of battery technology, Tesla also said yesterday it's shifting to a less expensive battery. What kind of difference do you think that will make when it comes to the fundamentals?
Well, I think over time, they could cut battery technology by 50%. And that's ultimately how you're starting to get more of the mass market, $40,000, $50,000 Teslas. That margin story is starting to show. And it just goes back to that is the moat. And that's why we believe this is a stock we've never viewed as an automotive company. It's a disruptive technology player. That's how it gets the multiple. And we view this as a $1,000 plus stock over the next 3 to 6 months.
Well, one of the maybe more disruptive technologies is the concept of Autopilot, and yet that has brought Tesla into a little bit of a scrutinized area in terms of the NHTSA investigating it. How do you think about that regulatory overhang?
Well, I mean, they're going to have to work with regulators because FSD, and when you look at just self-driving, that's a big part of the Tesla story in the latter part of the decade. Clearly there's been a black eye there that they've had to navigate. But I think what you're starting to see now, that they're working with regulators. They're going to resolve this. And it speaks to a company that is just so far ahead when it comes to FSD and vertical integration, because that's something that's unique to the likes of a Tesla and we call it GM when it comes to full self-driving.
Dan, you talk about a $1,000 price target. That's what you put on this business. Currently trades at 860 or so. You referenced, I think, a time horizon of just the next 3 to 6 months. What do you see as a catalyst to take us there? Because some people still remain, they might like the story, but aren't sure about valuation.
Yeah, and I think when you go into the next, call it 3 to 6 months, and this green tidal wave takes a next gear of growth, because what we're seeing on demand. China, I think that's the key of the story. That was ultimately, what we'll call it a headwind earlier this year. Now it comes into a tailwind. That could be 40% of deliveries going into next year. But it's Austin and Berlin coming on board. That's going to change the story from a supply perspective. And you start to navigate through this chip shortage, you got that tidal wave of EVs coming. And right now, at least on the EV market, Tesla continues to dominate. That was sort of the statement last night with numbers.
Dan, thanks so much. Maybe they're hoping then that we don't see anything too negative in the Chinese housing market to keep that economy afloat. Dan Ives, Managing Director of Equity Research and Analyst at Wedbush Securities, with his thoughts on Tesla numbers overnight. Coming up, it's a record quarter for Barclays. Part of our interview with the CEO, Jez Staley. We'll bring that to you next. He talks about investment banking and bonuses. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. Back to banking, and Barclays bankers made the most of the booming deals market, helping offset more muted earnings at its trading units in the third quarter. The CEO of Barclays, Jez Staley, spoke with Mark Cudmore and I earlier today.
Overall, the investment bank had a very solid quarter. In investment banking fees on the primary side, whether it's advisory, debt capital markets, equity capital markets, we had the highest quarter in the history of Barclays. And in the markets business, they continued with very strong profitability. And you'll have mixes between FICC and equities and in other parts of the business. But overall, we were very pleased. We delivered a record £7 billion year to date. Barclays has never been this profitable and never been this well capitalized, and the markets business has done its part. When we look at the environment for our business in the UK, I think there are two things that we sort of have our eye on. One is obviously the UK consumer focused on their balance sheet during the course of this pandemic, and borrowings, particularly under our credit card, has gone down, and gone down by quite some measure. What we're seeing now is actually the number of cards being held by UK consumers is now higher than it was pre-pandemic. The spend level by UK consumers is also now higher than it was pre-pandemic. But it'll take some time for the balances for borrowings by consumers to return to pre-pandemic levels, and that will have a headwind on the revenue level of our consumer bank. On the other hand, as you say, interest rates, we think, are going to start to move. And if you think about, in a simple way, a bank balance sheet, it sort of has 6 cylinders to it. 3 cylinders are where we extend credit, whether it's unsecured or secured through mortgages, and that's doing, I think, reasonably well. But then it's the deposit side, where we receive cash, and that is very much, the profitability is tied to where interest rates are. And right now, with interest rates close to zero, that's the side of the engine that really has been sort of stalled for the term of COVID. Interest rates start to move, and we will start to generate revenues on the back of the cash that's held with Barclays. That'll be quite positive for the bank.
The Barclays CEO Jez Staley speaking to Mark Cudmore and me a little bit earlier on today. Really interesting, Matt, though, to hear him. He went on to talk, he was talking there about interest rates, the rising interest rate environment in the UK. He went on to talk about bonuses, the variable compensation pool, as he calls it, will be increasing because of these record results. But a lot of similarities here in terms of the themes, at least, in the US earnings story and in Barclays, whether that's M&A being a real boom area or consumers, and consumers not having to borrow so much on credit cards because of the savings they've achieved on aggregate during the pandemic.
Yeah, absolutely. Loan growth is a problem. We've seen higher savings rates in the U.S. as well as in the U.K. and Europe. Also, FICC trading was down 20%, right? So not everybody is likely to get bigger bonuses. The M&A advisors did really well, but fixed income trading was down 20%. I think equities trading was up about 10%. So it's not the entire bank that's firing on all cylinders, or maybe I should say the bank isn't firing on all cylinders. It's just doing incredibly well on the 2 or 3 that are running.
I have to say, he didn't seem too concerned about performance of the FICC business. Equities cushioning that just a little bit for capital markets. The stock down 0.3% this morning. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz over in New York. Also in New York, Tom Keene, co-anchor at Bloomberg Surveillance, joins us now. Tom, just looking at US futures, looking as if they're going to catch the downdraft, or maybe they're setting that downdraft for European stocks, of course. What's on your mind?
How British, a downdraft. That about fits it. SPX down 0.2%. John Farrell always quoting Standard & Poor's 500. Ben Laidler out with a blistering note this morning, Anna, saying, follow the Dow Jones. He goes into, we don't need the details, but what we need is a chart which just flat out shows the underperformance of the Dow coming off the bottom of the pandemic, March 20 of 2 years ago. The NASDAQ 100 doing a lot better. SPX outperforms. Small caps lead the way. And the summary here, which I really, I knew, but I really didn't know. Laidler of eToro says the Dow Jones is growthier with a lot of growth potential in its new makeup.
Excellent. Growthier. Is that very, so downdraft's very, very British. Is growthier very American? Or did he just make that one up?
I stole it from Steve Colbert. I got to be honest. It's become part of the American lexicon as so much of Mr. Colbert's good work. But this is really important. We look at SPX is bank cyclical, a cross-section of America, 500 stocks, weighted correctly. I get that. The Dow has manufactured a more growthy index, according to Ben Laidler.
Tom, thanks. Tom Keene,
Sure.
co-anchor of Bloomberg Surveillance, up next. Now a look at what we are watching. And team, I'm focused on the EU summit. They're talking about gas. Will there be any action, or will it just be a lot of that sort of hot air and platitudes? There's a real row out in the open now between Brussels and Poland. And that does have the ability perhaps to distract from climate ambitions, which is interesting ahead of COP26.
Yeah, the countdown is on, Anna. Meanwhile, I am watching the Turkey rate decision. We're expecting it at 7 a.m. Eastern time. Economists expecting a rate cut of 100 basis points, even in the face of inflation that was 19.5% in September. Why? Well, we know that President Erdogan has called himself an enemy of interest rates, and he ousted 3 officials at the central bank last week who were more wary of interest rate cuts. So my question is, what will this mean for a lira that is already right around record lows against the U.S. dollar, Matt?
Interesting. I'm always watching Turkey as well, but also NCAA rule changes make it possible for college athletes to get sponsorships. As I told Dan Ives earlier, Ty Washington, a freshman at the University of Kentucky, has a new sponsorship with a local Porsche dealer and will be driving a Cayenne to school soon. This is Bloomberg.